Good everyone, welcome back to our next edition of Econ Talks. Gareth, we've had the latest GDP data come out for the September 2024 quarter, third quarter of the year, and it was dark, deep dark and horrible. In fact, looking at some pretty weak economic numbers, down 1.0% quarterly fall in the September quarter. Now that's bad, but it comes off an even worse 1.1% reduction in the June quarter. That was revised down quite heavily. Now, there are quite a lot of revisions that have come through in the figures. So despite the fact that you've seen two pretty steep falls, and we've now seen quite a comprehensive recession through mid-2024, the starting point for the economy was actually a whole lot stronger, a whole lot larger than stats might have originally envisaged. That's sort of, good from a starting point of view, but we've still seen more than 2% of economic activity cut out over the last 6 months or so. I mean, how bad is that, and what sort of sectors drove that result?
Yeah, well, if you put aside the lockdown affected quarters in 2020, that's the worst 6 month result for the New Zealand economy since 1991, which of course you won't remember, Brad, but some of us do remember how bad that time was. Unemployment running in double digits and all that sort of thing. So it is seriously, we're talking over 30 years since the economy has contracted at this kind of rate. And it does really reflect the extent of the pain that businesses have been feeling through the course of 2024. The numbers previously that Stats NZ have been publishing, we'd been flirting with recession, in and out of it a little bit, but they weren't really bad. But having revised those figures now, we do see what is a substantial recession that the New Zealand economy is going through at the moment. Looking at the industries that were most affected by that, manufacturing was one of the bad headlines, as it were, with just about every manufacturing sort of sub-industry across the board falling away. Some of the biggest ones were metal product manufacturing, which was down by 7.3%, largely influenced by, of course, the Tiwai Point aluminium smelter reducing production in response to the electricity crisis that we had through July and August earlier this year. Wood and paper product manufacturing, similarly affected by that crisis, also down by over 5%. So some big falls there. But like I say, right across manufacturing, the declines were pretty steep. And the electricity crisis also reflected in that particular sector, with electricity, gas, water and waste services declining by 3.7%. Now, that was kind of expected to be coming through in the numbers. What we're also seeing, though, beyond that is construction activity. We know that residential has been under pressure, and non-residential has looked like it's peaked and is starting to come off that high as well. So close to a 3% decline in construction activity coming through in the numbers there. And for the residential sector, that's 5 quarters in a row that it has been falling away, which again, you have to go back to the global financial crisis to see that decline or such a sustained and ongoing decline coming through with the numbers too. Probably one final area I'd mention for you would just be around government spending as well. When we look at central government consumption spending, that was down 2.7% in the quarter. And again, you have to go back to the early 1990s to see such a sharp cut in government spending. We had seen certainly a slowdown in government spending in previous quarters, but it has gathered pace as the current fiscal policy is starting to work its way through the system, and some of those spending cuts come through more to the fore. Apart from that, I mean, if you want to look at household spending as well, that's under pressure. We've seen that for some time. But household spending falling for the last 6 months now, so 2 quarters in a row, and it hasn't been weaker than that again since 99, 2000. So whichever part of the numbers you want to look at, they are very, very bleak indeed.
Well, and that's the thing, right? They are incredibly grim, and it's quite a comprehensive recession that we've seen. It's not just one or two industries, just about every industry saw a decline on the production side of GDP over the last quarter. On the expenditure side, all sectors of the expenditure side of GDP saw a contraction. You look at the likes of gross fixed capital formation, investment, and the likes of that other construction part of the economy, infrastructure investment, which had been pretty solid, fell fairly solidly in the latest quarter. And the first fall, I think, that we'd seen for other construction infrastructure investment since 2022. So, even some of what would expected to be more solid parts of the economy came back quite sharply. A few areas that seem to be doing all right, the likes of agriculture, seeing seeing some all right performance in the last quarter or two. The likes of renting and real estate and similar also doing better, but really not an area that you really want to be driving the economy, just doing more sort of with the merry-go-round of property prices, but sort of continued cuts across the board, very much being influenced by those higher interest rates previously. Now, not sort of withstanding the fact that the economic hit has been so much deeper, so much broader, so much quicker in a sense than we had have considered in the past, given that, we'd been looking at the numbers, they'd been down, but they hadn't been down that much. Actually, it seems that they have been, which probably gels more with what a lot of businesses had been feeling themselves. I mean, what are we sort of seeing in the future? That agricultural pickup seems a little bit better. The Reserve Bank is already cutting interest rates. Are we still looking for those greener shoots in the future, or have these numbers sort of changed things around a bit?
Yeah, I mean, you mentioned agriculture, and look, the trend is very much still upwards in terms of those meat and dairy prices through the course of 2024. And so we are looking for better times to be coming through for farmers, improved profitability after some big cost increases and falling prices in the previous couple of years. We are expecting that position to continue improving through into 2025. In terms of other green shoots, look, we've seen household spending just starting to track up in terms of electronic card numbers, at least over the last 3 or 4 months as well. And again, that gels with some of the messages we've been getting from businesses where things are not necessarily going gangbusters. That would certainly be overstating it, but they are just starting to feel that inquiry levels and demand levels are bottoming out and maybe starting to pick back up. So I guess there's a bit of a sense that when we look at this GDP data, it's telling us of what has happened, and it is, 3 months old, let's be honest. So things are still evolving over the last few months of the year. And as we look through to 2025, I'd suggest that things will gradually improve. We've got higher, certainly business confidence levels. There will probably be a bounce back in GDP in the December quarter anyway, because the electricity crisis has sort of fallen off the radar. Now, some of the effects of that crisis will be permanent, or at least semi-permanent, with some mills in the central North Island rather shutting, Tiwai Point aluminium smelter cutting back on production, and you don't just turn that pot line back on instantaneously. It does take a long time. So GDP up, we probably think in the December quarter at this stage, though not necessarily going strongly. But I think as you move further into 2025, I would expect a bit more momentum to start coming through in the economy as some of those other positive or slightly more positive indicators start to flow through into the GDP numbers.
Definitely, although, like you say, some of that is going to be, there are some sort of more semi-permanent or permanent sort of hits there in the economy. The likes of some of that manufacturing does seem to be in a more persistent, softer state. There's no guarantee we don't see a further energy shock like we saw this year, next year, when we get to that sort of mid-year period. And of course, the government recently highlighted in their half-year economic and fiscal update that, the fiscals look pretty brutal. They haven't got a lot of money free and available. In fact, they're continuing to run a structural deficit for effectively the next half a decade through until 2029. So with all of that, there are some still pretty big challenges there to the economy. And realistically, households are likely to bolster things as their interest rates come down and as they can spend a bit more. But businesses, they'll be still sort of waiting to try and get through some of the hit to profitability and the sort of hit to the equity they've probably drawn down on the last couple of years. The global economy doesn't look fantastic, and there's still a lot of risk and uncertainty there. Government won't be doing it, so it does seem to be left a little bit to the household sector just to get us back to maybe solid levels of economic activity, but it's certainly not necessarily going to be strong. We'll assess all of that, including how bad the economy has been hit and how we've sort of seen that in other data sets, but also that turnaround in better economic data as we go through into 2025 on one of our future editions of Econ Talks.